Hey, how's it going? All right, enough with the small talk. Today I'm going to tell you why I don't lose sleep when I invest in the stock market and what's worked for me and what may work for you, something to consider on today's Dapper Dividends. So let's get to it. Back in the day, around 2003, I was putting 5% of my money into mutual funds, and that's all I did. I didn't pay attention to it, so I didn't lose sleep. I wanted to get a little more hands-on, and they say that investing can be like a bar of soap. The more you touch it and the more you handle it, the more that it wears down, the more money you will lose. I tried penny stocks. I tried to swing trade penny stocks, then I tried to swing trade bigger companies, trying to use moving averages to get in and out, and I found that I am not a very good trader because I'm very emotional and I can't control my emotions. So I did find a better way, dividend growth investing. Simply put, I'm buying companies, blue chip quality companies that pay a growing dividend year over year that the world needs. As a dividend growth investor, when I buy income, I'm looking at that money as a sunk cost. So I'm not as concerned with share price as I am with the stability and safety of a growing dividend. I look at that money as gone. I can't get it back. It's locked in the company. The only thing I do get in exchange is a growing and infinite dividend, obviously, as long as the company keeps paying it and nothing changes. I am only concerned with the dividend that they are paying me. A big mistake that beginners make is looking at the yield and the share price. You could have a stock that's $1 and insanely overvalued, and another one that's $350 and incredibly undervalued. You can't just look at yield or share price. There's a thing called yield trap when companies want to pay a really high dividend yield in order to attract investors, but they can't sustain that and they can't keep paying that over time. And as I was saying, why do I sleep easy? Because the share price, as I said, is a sunk cost. When we had the market crash back in March and April, I tested this out myself. It was beautiful. It worked out fantastic. People were freaking out, selling, panic selling everything, and I was buying. I could care less. At one point, my portfolio was down. I'm not going to give an exact amount, but it was down thousands of dollars, and it didn't faze me in the least. I didn't lose a moment of sleep because I knew that over the long course of time, dividend growth payers and the market go up and to the right. It's just a matter of time. The market does not go down over the long term. So that's basically it. It really is just that easy. I buy a company, the price I paid for it is largely irrelevant. Yes, there is a whole system because the cheaper you can get them for, the more bang you get for your buck. So when companies do drop in price, I do look to buy a lot more of them. Dollar cost averaging works really well because when prices are high, you're buying less, and when prices are low, you're naturally buying more. It's such a fantastic system. Dollar cost average in and buy blue chip quality companies like Pepsi. Bubbly. It's sober October. I have 6 more days to go until I resume my regularly scheduled alcohol consumption. But Bubbly is a PepsiCo product. And speaking of buying companies like Pepsi, I'm going to show you another company I bought this week that took a little bit of a tumble, and I'm swooping in and buying up some of those shares. That company is Kimberly-Clark. Before we get to Kimberly-Clark, do me a favor. Please hit the subscribe button. It's going to take you 1 second to do, and it costs you nothing, but it means the world to me. Thank you. Kimberly-Clark, you probably know them. You probably don't love them like I do. They have been in business 148 years. 1/4 of the world's population uses their products every single day, and they are sold in over 175 countries, regions, and locations. Look at all those brands they got. You know them. Cotton Alviva, Scott, Huggies, Kleenex, They got all kinds of things. They have adult diapers, even in black for formal wear, for all those formal occasions when you need to control your bladder leakage. Baby care and feminine care, as I always say. Kimberly-Clark, they're all about wiping butts and blowing noses, and people are going to need to do that as long as there are people around. I wanted to show you their KC Professional segment. Check that out. Look how diverse they are. Do you know anybody else who welds? That's right, yours truly is a welder. They do have products that welders use, such as myself. Oh, check out this fun little tool on their website, the investment calculator. If you were to put $100 into Kimberly-Clark on January 1st of 2010, today, it would be worth $316 for a 392.1% return. You gotta love that. With reinvested dividends, you would be up to 2.3 shares. Something that I see in my line of work a lot as companies and especially warehouses are transitioning to touchless. This is something that they have a little bit of a part in with their touchless paper towel dispensers and the soap and sanitizer dispensers, as well as touchless air fresheners. And they were down after earnings to $136.88 they closed out the week at. And the recommendation trends that they do give is largely a hold, with some over there in the buy range. 2.5, it's in between a buy and a hold. They have an average consensus target of $160. And right now it is well below that after their earnings. Something I like to look at to see if they're undervalued is the PE ratio against themselves. Kimberly-Clark is currently at 19.90% PE ratio, but it has a 5-year average of 26.50, which makes it about 25% undervalued according to its own PE against itself. I love looking at the dividends here. Nice up and to the right, usually growing at about a 3 to 5% clip as of late. They're going to keep growing that dividend. The 5-year growth rate is only 4.2%, not world beating, but it's good enough for me, and especially look at compared to their peers. When you compare them to Colgate, Clorox, and WD-40, they do pay a much higher yield than them, which is the only thing that I am concerned about, is that their yield is going to be sustainable and they are going to keep growing that dividend, which I have every faith in the world that that dividend is going to keep coming for years and years. Market Beat does show that they have a 49% free cash flow payout ratio. They've been paying that dividend growing consecutively for 24 years. They do pay $4.28 currently, and one more quarter they're going to pay that, and then they will be due for their raise. On Market Beat, with their analyst's opinion, it is $156.13 is the consensus price target, so it has a forecasted upside of about 14% from the current $136.88 price range. Again, you know me, I love looking at net margins, currently at 13.58%. I love seeing net margins over 10%. Another metric I love to look at is 71% of their stock is held by institutions. These are mutual funds, these are hedge funds, these are companies that expect them to be doing very well for a very long time. A couple numbers I just wanted to talk about from their last earnings. Now, their net sales were still up 1%. Personal care, you can see, makes up 50% of their sales mix, of their revenue. KC Professional was down as there were a lot of restaurants and businesses that were closed. A lot of the office businesses are closed, so it makes sense that the KC Professional segment is going to take a hit, but make up for it. Look at that. Consumer tissue, all the toilet paper, all the people wiping their butts and blowing their noses, going to keep propping up Kimberly-Clark. I love what their CEO here, this quote they pulled, that they returned approximately $560 million to shareholders through dividends and share repurchases. They love giving that money back to us, and rightfully so, the shareholders. For full year 2020, they expect the net sales to grow 2 to 3% and organic sales to grow 5%. The gap is expected to be 641 to 672. And adjusted earnings per share, $7.50 to $7.65. And if you remember that the dividend is $4.28 per year. So what I see is short-term volatility that gives me a great buying opportunity for long-term growth and stability. Charles Schwab, which generated this report on the 24th of October, gives them a C or a hold rating. Morningstar gives them a fair value estimate of only $120, and Morningstar still says that the shares are not a deal. But as I said, I am buying for dividend income. I'm buying for that infinite income. So I am not as concerned about looking for a deal. But obviously, when share prices do keep falling, I will keep buying. It's a win-win for me. And lastly, CFRA report gives them a 4-star buy rating with a 12-month target of $156. That's Kimberly-Clark. I love Kimberly-Clark, as you can see. I am buying them for dividend growth income. I'm buying them for the stream of money that they're going to keep paying me. Confidently, I am buying Kimberly-Clark. Some of the best expertise comes from community members. So in the comments below, let me know what you think of Kimberly-Clark. Let me know what you think of any stock, any dividend growth company, anything I've talked about here today. And speaking of talking about it, let's talk about what I bought in this week's dividend roundup. This is my taxable portfolio, and this is the kind of nonsense I'm talking about. It is always loading, so I can't get my data, but you can pause this and you can see exactly what I have and the averages that I have it at for the taxable account. And the same goes for the self-directed IRA. It's just always loading. We can't see it, but the critical information is here, and I scraped this from FinViz. Don't know why it's giving me problems. If you do know, give me options. Give me a suggestion on something else that I could use instead. And if you head to my website, dapperdividends.com, my roundup got a quick little blurb about everything that I bought. I received dividends from Cisco, ticker symbol CSCO, $7.20, and Simon Property Group, $13. I will be looking to move Simon Property Group and shift them into the self-directed IRA. They are the last of the REITs that I have left to do that. I received $20.20 of dividend income. And the buys of the week, I bought my 1 share of Pepsi. Every single week we're doing it. We're buying a share of Pepsi, $139.75, added $4 of annual income. Did you know that Pepsi was the first American product that was manufactured, marketed, and sold in the Soviet Union? ExxonMobil, I bought 2 shares. I'm continuing to buy. Put my money where my mouth's at, $34.95. Under 10%, obviously yield is a function of stock price, so the lower the price goes, the higher the yield goes. 9.96%. Exxon and Mobil merged in 1999 in an $80 billion deal. I bought 2 more shares of Merck. I'll probably be buying 1 to 2 every week till they get to full position. Merck, $78.32, only a 3% yield, but again, solid company that gave me a total of $4 of dividend income. And they were founded in New York City in 1891 by George Merck, and he founded it as the U.S. branch of his family's company, which dates back in Germany to 1668. That's a lot of history for Merck. I bought the 2 shares of Kimberly-Clark. Look at the difference a day makes. This 149 was before earnings and the 138 was after earnings. So the yield, as you can see, the lower the price goes, the higher the yield goes. There it is right there. I bought the 149s at a 2.87% yield, and the 138s was a 3.08% yield. Price goes down, yield goes up. Price goes up, yield goes down. And Kimberly-Clark has boosted their dividend in each of the last 47 years. Last but not least, AbbVie. I love my AbbVie. I bought 1 share at $84.70 for a fantastic and whopping 5.57%. Look at the breakdown. I'm getting close to $1,600 a year, $132 a month, $30 a week, $30 extra a week if I didn't reinvest that. How awesome! $4.35 a day. I'm getting closer to quarter an hour. 18.11. This is just going to keep going up every week with my DCA and reinvesting dividends. And the self-directed IRA, not too much going on. Did receive Cisco shares, only $3.24 of dividends. And 1 share of Kimberly-Clark I bought after the earnings for $139.50. And that was a 3.07% yield. And the SDIRA is at $1516.31. That's $126 a month, $4 a day. So they're kind of close, 17 cents an hour. And as always, we give myself 5 stars because I am a 5-star recruit. Thank you. Cool. Let me know what you think of all this in the comments below. If you haven't done so already, hit the subscribe button. It's free for you. It means the world for me. Show me some love. Follow me on Twitter at RustyRam78. I'm on there every day, chitting and chatting, sharing some motivational thoughts and opinions. I do a podcast also called Dapper Dividends every Tuesday and Friday. You can find that on all the major podcatchers and my website, dapperdividends.com. And the disclaimer, this is not financial advice. None of this is financial advice. I'm not a licensed financial advisor or a fiduciary. You need to do your own due diligence. Putting money into the market does carry loss of risk. Know your long-term goals. I have a specific goal every single day that I'm working for. It's what gets me out of bed. Have a goal. Make sure that it fits your long-term goals, whatever you are doing today. And just one more thought. Where you are right now only becomes a destination if you stop moving. Keep learning, keep reading, read audiobooks, put as much knowledge into your mind as you can, because what you put into your head will come back to your bank account in dollars. I firmly believe that. Check out another video, and I will talk to you guys later.